Welcome, welcome, welcome. Good afternoon, everyone, and welcome to today's discussion. It's the final in our series of discussion. Today, we'll be discussing how to evaluate industries. Right? But while we give some of the other audience members some time to just log in and catch up, I want you to put in the chat which school you have evaluated as the winners of Champs 2025. It's Champs. Which school you're repping? Like, they don't have evaluate anything. Just put in the chat which school you're repping for Champs while we wait on the others to join. Calabar out the gate. Welcome again and good afternoon to those of you who have just joined. Today, we will be discussing in our series, Invest Like an Owner, we will be discussing how to evaluate industries. Now, I want to advise you and help us to understand that investing isn't just about picking stocks. It's about understanding the industries that are behind them. And as business owners at the heart, we must assess industries like they would if we were running them ourselves. Now, today on our panel, we have Raju Gunnings. He's a senior research analyst. We also have Andre Rumble. Andre is the assistant manager, portfolio management. And we have Jamie Muir, who is the research analyst with a focus on equities. Gentlemen, which school are you repping for Champs?
You know, I'm from West
Ocean. I'm seeing Casey, I'm seeing Calabar, I'm seeing Immaculate.
You know, I'm from West Ocean, so I represent Mannings, blue blood through and through.
Despite some people in the chat will ask if that's true blue.
Despite it all, I'm expecting Meadowbrook to cause some disruption in this year, champ. So I look out for that.
And for me, O'Shane, I get quite guess all the way. Wolmer's boys. That's what I'm repping today. You know, that's my old school.
Okay. Interesting. We will see. I won't tell you who I think will win Champs as yet. I will tell you at the end. All right. Because, you know, I know how to evaluate Champs. But today, in evaluating industries, we have Raju Gunning, and he will help us to understand how it is that the industries work, what key factors we should analyze when evaluating industries for long-term potential.
Thanks, O'Shane. Hello, everyone. I'm Reggie Gunnings, Senior Research Analyst, and I'm elated to provide guidance on investing in the stock market to build generational wealth. Today, I'm presenting on the topic Sector Savvy, how to evaluate industries for smarter stock investments. In this presentation, I'll briefly define what sectors and industries are and share why investors should care about them. Then we'll learn about industry growth cycles and how it can help with stock selection. Once that's done, we'll discuss tools and techniques that can help you to be a sector-savvy investor. And as usual, I've sprinkled examples throughout the presentation to help bring the points home. But if you have any questions, we ask that you hold until the end of the presentation when we'll have our question and answer segment. So, what are sectors and industries? A sector is simply a broad group of companies that operate in the same area of the economy. Every company, including those listed on the Jamaica Stock Exchange, belongs to at least one sector. Take the financial services sector, for example. This includes big banks and insurance companies like NCB and Sagicor, but it also includes smaller firms like Dollar and Access, which are microfinance companies. The manufacturing and distribution sector is another example, home to companies like Seprod, Wisynco, Carreras, and Carib Cement, to name a few. But it doesn't stop there, because we also have sectors like tourism, real estate, energy, and even technology. Now, within each sector, we have industries, which is a more specific group of companies that produce similar products or services. On the Jamaica Stock Exchange, for example, financial services sector includes industries like banking and insurance. Now, some companies operate in multiple industries within the same sector. Take Sagicor. It's involved in both banking and insurance industries, both of which are a part of the financial services sector. Then there are companies that span multiple sectors. Grace Kennedy is a good example. It's in financial services through GK Money Services, Key Insurance, and First Global Bank, but it's also a major player in manufacturing and distribution sector with Grace Foods. Everybody knows the Grace Vienna sausages and the broad beans and the tropical rhythms. So when you look at the Jamaica Stock Exchange, we see a diverse mix of sectors and industries. I know after hearing all of this, you might be thinking, okay, that's good to know, but why should I care? Well, the reality is that sector and industry dynamics can have a major impact on a company's growth and its competitiveness. And whether we take it from an industry sector or from an industry or sector level, the same principles ring true. And for those who attended our previous webinars, you may remember that a company's growth prospects and competitive landscape can directly affect its profitability, its ability to reinvest for growth or to pay dividends, and ultimately the true value of the stock. And if the stock price does not reflect the company's true value, it can mean opportunities to buy or in some cases sell that stock. When we talk about an industry's growth prospects and competitive landscape, one of the biggest drivers is where it is in its growth cycle. Just like people, industries evolve. Different sources may break it down in various ways, but most industries grow through at least 3 key stages. You have growth, maturity, and decline. And every industry falls somewhere in this spectrum. And knowing its position can reveal a lot about future opportunities and challenges for the member companies. And what we tend to see is that local companies have a core industry, but look to expand in other industries, especially those with exciting growth potential. This helps them to stay relevant and adapt to changing customer demands. Let's start with the growth stage. Think of it like a baby growing into a young adult. It's fast, it's exciting, and full of potential. Companies in a growth industry often see rapid expansion, strong demand, and continuous reinvestment in their business. Globally, for example, an example would be the artificial intelligence industry, with a company like OpenAI, which created ChatGPT, benefiting from the AI industry's rapid expansion. A good example locally is the renewable energy industry, which has a huge untapped potential in Jamaica. In fact, the government of Jamaica is aiming to generate 50% of the company's electricity from renewable sources by 2030. Last year, the number was only 10%. So the expectation is there that there will be an accelerated demand to meet this target, which also aligns with the global push towards cleaner energy. Companies in this space like Tropical Battery are therefore poised to benefit and could see significant profit growth if these targets become a reality. Now, while growth stage companies have big earnings potential, we have to be mindful that they also reinvest heavily, which means that cash flow can be tight and dividends are not as frequent. Their priority right now is to expand to improve their ability to pay as much and dividends as frequently as possible in the future. But with high potential comes high risk. Since the industry is still developing, execution risks are at their highest. This means that things might not go as well as planned. But if companies succeed, The rewards can be huge, but if they struggle to gain traction, investors could get lower returns. After the growth stage comes the maturity stage. Think of this like an adult. Growth still happens, but it's slower and more steady. Companies in mature industries tend to have stable earnings, strong market positions, and consistent demand. At this stage, clear market leaders often dominate, while smaller players may struggle to compete. Instead of rapid expansion, companies might focus on efficiency, pricing power, and brand strength. But that doesn't mean they stop growing. Many look for new ways to expand, whether through innovation, they might do some acquisitions, or they might enter new industries, like an exciting new growth industry. A big advantage of mature companies, though, is that they generate strong cash flows and are more likely to pay steady and growing dividends. A great example is Carreras, one of the strongest dividend-paying companies on the Jamaica Stock Exchange. While the tobacco industry is mature, and to be fair, some might argue that it's starting to decline, Carreras is still driving growth by innovating. For instance, it's expanding into the vape market to adapt to changing consumer trends. Another way companies in the mature phase drive growth is through the mergers and acquisitions. Separate has used this strategy effectively, acquiring other businesses to strengthen its market position and expand its product portfolio. So while mature industries may not have the explosive growth of growing industries, companies that innovate, acquire, and expand can still create new opportunities for investors. All else equal, mature industries tend to carry less risk than growth industries. For people close to retirement or already retired, these companies can be especially attractive. They're usually not as expensive from a valuation standpoint, and their dividend payouts are steady, providing a consistent income stream. But needless to say, they're still attractive to all types of investors. Next comes the decline stage. After growth and maturity comes the decline stage. This is when industries lose momentum or they start to fade. And you can think about it similar to old age. Industries start losing momentum and shrink as consumer habits change, technologies evolve, or economic conditions shift. Right? Demand often falls, leading to lower profits and dividend payouts, and in some cases, the business is shut down. Weaker companies either get acquired or disappear as the market consolidates. Some companies fight to stay relevant by reinventing themselves, whether through new business models, innovation, or digital transformation. At this stage, the risk is higher than the mature phase, and it's all about survival. Only the most adaptable companies make it through. Real-world examples include theater and cinema industry. Once a go-to for entertainment, cinemas have been hit hard by streaming services like Netflix and social media platforms like YouTube. People just aren't going to the movies as much anymore. And as such, a local company like Palace Amusement might see fewer moviegoers, translating to declining revenues and profits. If a company in a shrinking industry isn't innovating, it might be a sign for investors to exit. So what's the key takeaway? In declining industries, companies either evolve or they fade away. And as investors, recognizing this is crucial. I know that was a lot to take in, so on this slide, I prepared a quick summary of the typical traits of each stage of the growth cycle. You can see in the growth stage, profits are increasing, dividends are increasing, but the growth potential is very high. Competition is increasing because other players might see the growth potential and they might start to enter the market, but the risk is relatively high. For a mature industry, profits and dividends are high. The growth potential is a little bit more moderate than the growth industry. Competition is intense and the relative risk is low. And then for the decline stage, profits and dividends can be declining. The growth potential is lower. Competition is decreasing as more companies exit the market, but the relative risk is still high. Now that we've gotten a better grasp of sector and industry dynamics, let's talk about how we can use that knowledge to our advantage. There's a saying, birds of a feather flock together. And in the stock market, this is definitely true. When something impacts an industry or the wider sector, whether it's a positive factor like a rising demand for renewable energy, as we spoke about in the example, or a risk like rising interest rates, stocks within a sector often move in the same direction, and this is called high correlation. A savvy investor understands these dynamics and uses them to their benefit. Some investors focus on a single sector with good news and exciting trends through thematic investing, while others prefer to diversify by getting exposure to multiple sectors. So let's start with thematic investing. Thematic investing is when investors focus on a few specific sectors that they believe will benefit from the most the most from the big trends, or what we call mega trends. For example, one such trend is Jamaica's aging population. The PIOJ has projected that by 2050, approximately 20% of Jamaica's population will be over 65, and this will surpass the number of children, or the percentage of the population that are children. They also highlight the need for strategic planning in healthcare, social services, and economic opportunities for the elderly. This mega trend could boost industries in the health sector and companies like Indus Pharma, your Fontana Pharmacy, or your Image Plus consultants. On the flip side, savvy investors also use their knowledge of sectors to reduce the overall risk of their portfolios through a strategy known as diversification. Because different sectors react in different ways to economic conditions, when some sectors are doing well, others might be struggling. But by diversifying, we can reduce our exposure to risks from any one industry. Especially since we can't predict when those risks will materialize, diversification acts as a safety net, preparing us for the worst case scenario. A great example is COVID-19. The pandemic took a heavy toll on stocks dependent on the tourism sector, while other essential sectors like food manufacturing and distribution remain steady. In fact, diversification is one of the reasons why we have a buy recommendation on Grace Kennedy. Grace Kennedy operates in both the manufacturing and distribution and the financial services sector. So if one sector is underperforming, the expectation is that another sector might be able to buttress or to alleviate the decline in the other sector. And for us at NCB Capital Markets, in terms of what our approach is, both thematic investing and diversification have their advantages. And that's why we recommend getting the best of both worlds. You want exposure to sectors with exciting themes, yes, but at the same time, you also want to diversify. This way, if one or more sectors don't perform as expected, others can help to balance things out. It's a strategy that ensures that your portfolio can outperform no matter what the market throws at us. This is also why we primarily recommend stocks in the growth or mature phases. By doing so, we can ensure that we're sticking to Law 3 of the 5 laws of wealth creation, which is investing in companies in strong long-term growth industries, or in this case, sectors. But it's not just about the industry. We also have to focus on companies that are the best in class, the best of the best. And this strategy gives us the confidence to hold onto these businesses for the long run, which ties into Law 5 of the 5 laws of wealth creation. Now that we're on the same page about getting the best of both worlds, you might be wondering, how does a sector-savvy investor pick winning stocks? It's about keeping an eye on the developments within the sector, the industry, or individual companies. These changes can signal that it's the right time to dive deeper, analyze, and pick top performers based on both qualitative and quantitative factors. And as we discussed in our last webinar, qualitative factors include things like corporate strategy, whether or not the company has an economic moat, or whether or not the company has strong management. On the other hand, quantitative factors include financial performance and whether or not the company has a competitive valuation relative to similar companies in the same industry or the same sector. And when it comes to keeping an eye on a sector or industry and the trends that are driving those sectors and industries, as well as individual company insights, there are several reliable sources to turn to. You can follow the media, like Observer or The Gleaner, along with government agencies like the Statistical Institute of Jamaica, or STATIN, and the Planning Institute of Jamaica, or PIOJ, because these organizations provide valuable updates on sectors and industries. The Jamaica Stock Exchange is also another key source. And this is because this is where companies release their annual reports and make important announcements. This helps us to track company performance and get insights into the broader industry and sector trends. And of course, I'm saving the best for last in my opinion. NCB Capital Markets offers timely updates, along with our in-house research, which covers high-level sectors all the way down to individual companies to keep you well-informed on major developments. And when we see those key or major developments in a sector, it triggers a deeper analysis on the individual stocks. First, we evaluate those qualitative factors or those qualitative fundamentals that I mentioned of the companies. And this helps us to assess to see if they're well positioned to benefit from the changes in the sectors or the industries and create value for our clients who are the shareholders. So this will include a critical assessment of the company's corporate strategy. So for example, if a company says that they're going to expand, we're going to do a critical assessment of that. We're going to also be assessing its competitive dynamics, if there are many competitors in the space, and whether or not that company that we're assessing at the time is able to beat those competitors based on its qualitative factors. And there's so much more that we monitor in terms from a qualitative standpoint. But we also conduct a quantitative analysis where we compare the financial metrics like profitability, liquidity, and solvency, as well as valuation metrics relative to other companies within the sector. And this allows us to pinpoint those companies with the strongest growth prospects that are at the fairest prices. And as we say, best in class. Take Honeybun, for example. We currently have a buy recommendation on the stock because of their investments to more than double their expansion capacity and improve their distribution efficiency. This will help them to meet the growing demand for their products. You ever had one of those Honeybun donuts? I can tell you they're delicious. Our research also shows us that the manufacturing sector on a whole is seeing a significant rise in their investments to meet this demand. Back in 2024, the research team would have conducted some analysis and realized that the manufacturing sector would have spent at least $20 billion to ramp up their capacity to meet this demand that you're seeing in the market. And we're confident in Honeybun's strategy. It's achievable, and their financial metrics are stronger than many of their peers. Plus, the full potential of their growth isn't fully reflected in the stock price as yet. So all else equal, a savvy investor would consider buying Honeybun shares. So we're at the end of the presentation, and I know that was a lot to take in. But what we will say, so I know that it's a lot to take in, and honestly, it's not always as feasible for everyone, especially if you're busy with managing family and work commitments. But not to worry, NCB Capital Markets has got you covered. We have the talent, the time, and the training, the 3 T's, to monitor these developments, integrate them into our stock recommendations, and provide you, our clients, with timely updates through email as well as on our website. So you can still be a sector-savvy investor by becoming a client and letting us do the heavy lifting for you. Back to you, O'Shane.
Thank you, Raju. Thank you for that treasure trove of information, helping us to understand how it is that we should evaluate and what we should look for when it's that we're going to invest in a stock. We should cover the industries as well. I have a question for my audience. What do you invest in? Do you invest in industry leaders or do you invest in growth companies? You can put it in the chat and let me know. I have a question, Raju. I don't know if you want to say the question or at the end, but what role do industry leaders play in the industry investment potential?
The question is, what role do industry leaders play? So industry leaders are those companies that are at the forefront of a growing industry or a growing sector. So if you think about it, if an industry on a whole is growing and you have somebody that's in the space that's the leader of that industry, chances are it's the industry leader that's going to benefit the most. And if that industry leader benefits the most, for example, if we think about the renewable energy demand that I spoke about, and you see that ramp up in demand for renewable energy in Jamaica, chances are that most of the demand, the industry leader will be able to benefit from that demand and see rising revenues. That rising revenue is going to translate to higher profits. That higher profit is going to translate into greater reinvestment for growth. But for those investors that are looking for that cash, that dinero, those industry leaders are best positioned to see significant improvements in their ability to generate dividend payouts to investors. So that's the role of industry leaders in a growing industry or a growing sector.
All right, thank you, Raju. I have another question. I don't know if you want to take it or another panelist would like to take it, but I heard you mention the 3 T's, right? Sounds to me like I can just sit on my hands and NCB can just do the work for me. I just need to provide the cash, right?
That's correct. That's correct. And maybe Andre can, answer that question better than I can, but that's precisely right. We have the time, we have the tools, and we have the talent. And for investors that might want to pick individual stocks, we got you covered. But for investors that want, to take their hands off the wheel and let the professionals, especially if you're new to investing and you're not so sure how to get started, that's where our unit trust will come in. And I believe Andre should be able to, add some more color to that.
Certainly, Raju, and you said it perfectly. The unit trust products that we offer really help clients to build wealth for the long term. And in the case of being able to not worrying about picking stocks themselves, we have a perfect portfolio that can help clients with this. And this is the Caribbean Equity Fund. So this fund, it helps clients to generate long-term capital appreciation, primarily through equity securities. And this portfolio utilizes a dynamic mix of growth and value investing strategies. But I know you had mentioned some of the laws of wealth creation, and I'd also love to share that at NCB Capital Markets, we don't just talk about wealth creation, we lead from the front with it. So in the Caribbean Equity Fund, we follow the 5 laws of wealth creation in our stock picks and how we go about investing, because we are investing as owners on behalf of owners, which are you, the unit holders. So just a quick overview, the 5 laws of wealth creation. Rashni touched on a few of them. First, own a few high quality businesses. Second, thoroughly understand these businesses. Third, ensure these businesses are domiciled in strong long-term growth industries. Fourth, use other people's money prudently. And that is definitely something that will help you, the unit holders, to get the most as you have access to professionals like myself and my team to help manage your money and grow your wealth. And fifth but not least, hold these businesses for the long run. So before I jump further into the unit trust, I just want to take it back a few notches. And for those who know already, that's great. But for those who don't know what a unit trust is, it is a way for people to invest their money together in a pool, which is then managed by professionals like myself, who invest in a mix of assets like stocks, bonds, real estate, and in the case of the Caribbean Equity Fund, stocks. So this helps to spread the risk, making it more affordable and lower risk for individuals to invest in the stock market without having to buy these assets themselves. Because let's face it, life is dynamic. There are so many things tugging at your time day in, day out. So if you love to be able to get the benefit of the stock market without having to watch it every day, you can come to us. And it's a simple way to grow your money over time without needing to be an expert in investing. Mind you, you will definitely grow in understanding and being an expert by coming to NCB Capital Markets, catching our information from the research team. A lot of nuggets shared every week and routinely from them. And also, as it relates to who is this for, right? This is for investors with an aggressive risk profile who are seeking a well-diversified equity portfolio. But don't worry, if you're not sure what type of investor you are, again, we have you covered here at NCB Capital Markets. We have a risk profiler tool that can help you to figure out what type of investor you are so that you're going into the right products that suit your risk profile that ultimately helps you to grow wealth in a way that is comfortable for you. Because let's be honest, we want to get it, but we don't want it to make us lose sleep every night, right? Wealth building should be enjoyable, and it should be something that really makes us feel good versus worrying what's going to happen here, what's going to happen there. So that covers it as it relates to an overview. But one last thing before I pass it back to Oshane. Year to date, our fund has done 0.29%. And for reference, the benchmark, which is a collection of stocks in the market that are measured against, that benchmark is doing negative 6.74%. So you're investing for the long term. And with NCB Capital Markets Caribbean Equity Fund, you definitely can see returns that not meet the market, but beat the market. And that's why you're giving us your time and your effort and your hard-earned money to give you returns that can help you to do better than if you did it on your own, especially if you're not ready to do it on your own as yet. And last thing I say, we aren't just trying to do well here to show, but it's also important to note that of the 8 competitors in the industry, our fund, the Caribbean Equity Fund, currently is second of 8. And we're really working to grow the returns and to really be best in the market so that we can deliver the best returns for you, the owners of the fund, so that we can help you to build wealth in a way that is much more enjoyable.
Thank you, Andre. Thank you. So you answer the question. So we can sit on our hands and NCB Capital Markets will do the rest. Appreciate it.
Indeed.
Appreciate it. So to my audience, so if it's that you have a little bit of, I don't want to say fear, I want to say reservation in investing in the stock market because you don't think you fully understand an industry, NCB Capital Markets is here to help you with understanding and making money. You just sit on your hands. You invest in the fund and the fund managers will do the rest. Thank you, my panelists. Now, for my audience, just to put a plug here, this session is being recorded and it will be placed on NCB Jamaica YouTube page. So if it's that you need to review these or any of the past webinars, you can visit the YouTube page and you can rewatch the webinars. One of the things that I like about these webinars, I mean, I like the subject, invest like an owner. And you heard Andre today, and you heard Raju mention it as well. It's like, there are some specific things that you can do to ensure that you create wealth, right? They mentioned 5. You need to own a few high quality business. You need to understand these business, ensure that these businesses are in the long-term growth industries, use other people's money, and hold the business for the long term. And these are things that we've covered over the last couple of weeks. But here we are in the question and answer session. So if you have questions, you can place them in the chat. We will go through as many questions as is possible. All right, I want to say thank you again, gentlemen, for this wonderful session. Now, question coming into the chat. First question, can I purchase shares in the companies that were mentioned in this presentation? And how do I go about getting started? All right, I can go ahead and answer that. Oh, you're going to go ahead? Go ahead.
No, that's fine. Go ahead. That's okay.
All right, so with NCB Capital Markets, we have many avenues to get you started. So first thing you need is a broker account. You can open a broker account by visiting our branches, speaking to a wealth advisor. You can open it on our website, goipo.jncb.com. We will drop that in the chat. Or at the end of this session, there will be a poll. What you can do is that you can input your information in the poll and we will reach out to you to help you to get started. Next question is, how can investors assess a company's long-term potential before investing? And where can we get this information?
Sure, I can take that one, Oshane. So it's basically, you know, going back to what we would have spoken about in the presentation, right? So there are different approaches, but one recommendation is for you to do what we call a top-down approach. A top-down approach means that you're starting from the top in terms of some of the key drivers of a company's performance until you kind of narrow down and zone in on a specific company. What do I mean by this? Top-down approach means that we start from the highest level. In this case, it will be the sector and the industries. Remember, we said that a sector is basically a group of companies that have similar characteristics, and then the industry is just a little bit more focused and concentrated than that. So you have the sector, you have the industry, and then below that you have a company. So a company is in a specific industry, and that industry forms a specific sector. So when we do the top-down approach, what we're looking out for is signs of increased demands or growth potential in a specific industry or sector. We mentioned that the growth and the mature phases are the ones that NCB Capital Markets primarily focus on because that's where we normally see the strongest growth potential. So once we identify sectors, and especially if there are any major developments, so let's say, for example, if we say renewable energies, we're saying, okay, we see where that strong demand for renewable energy is going to come into play and it's going to affect companies that are in the space. Once we do that now, the key then is for us to say, okay, which companies are in that space? We said a few. You have your Tropical Battery, you have your Wigton. Once we identify the companies that are operating in that space, then we need to find out which companies are best equipped in terms of the qualitative factors and the quantitative factors to determine this company is best in class, it's best equipped, and then based on where those fundamentals lie, we are able to find a valuation. Once we have the valuation for the company, we compare it to where the stock price is. Because remember that price is what you pay, value is what you get. So a company can have value, but maybe the stock price is a little bit too high based on our assessment of the company's fundamentals. And once we identify a company that is in the right sector, that has the right fundamentals, and is best in class and has the right valuation, then we can say, okay, this is an attractive buy opportunity and we recommend it to our clients. Now, in terms of where we can get information to support the claim that a sector is going in the right direction, and then we do that top-down approach, we would have mentioned that you can get information from government websites like your Statistical Institute of Jamaica, because they publish information in terms of, you know, where different sectors or industries in the economy are performing. So they might speak about how the manufacturing industry is doing, and they might give a short-term outlook. Between Statin and PIOJ, they do provide that sort of information. But then there's also newspaper articles or the Jamaica Stock Exchange, where you can get additional information in terms of where a sector is going or how companies within that sector is performing. And we mentioned that on the Jamaica Stock Exchange, companies publish reports in terms of what their annual report is. A lot of the times, companies give guidance in terms of their expectations of where the industry is going. And while you can take one company, you can also look at it holistically in terms of what's the broader sentiment for companies within that space. And once we have all that information, you also need to remember that NCB Capital Markets, and I think this is where the real value added is. NCB Capital Markets, we're going to be doing all of that. I know I said a lot just a while ago. We're doing all of that information, all of that calculus in the background. We're doing all of that processing of all of that information. And once we process that information, then we know we can tell a client that, okay, we made an assessment, the industry is growing well, and the companies within that we would have identified a couple of companies that have the right fundamentals to, you know, make the most of an industry that we think are growing. So long story short, we do a top-down approach. We find the companies or the industries that have the best growth potential from various sources, including Statin, newspaper, and for me, the greatest value add is from NCB Capital Markets. And once we find that, that's a trigger for us to say, okay, let's see which company in this industry has the strongest growth potential based on where the industry is going, but also in terms of what the company's fundamentals are. And then that's how we'd be able to know that there is a company that is able to benefit from those long-term growth trends that we're seeing in the broader industries.
Thank you, Raju. Another question. Philip is asking, can we see the trend of one of these units that we're talking about so that they can feel confident to invest in it? Yes, we can. On our website, ncbcapitalmarkets.com, under the section rates, it's updated at least every day, but it's probably a day behind, right? So because information changes during the day, so at the end of the day it changes. So if you go on the website, you will see the performance of the different funds, and you'll be able to get some information from there. All right, Philip,
Sorry.
if you have follow-up question, Philip, you can provide. Go ahead, Andre.
And to add to that as well, Oshane, and we also have fact sheets that we generally have posted on the website just to give you an overview of the funds and their historical performance as well, so you can also get some of that historical trend that you're looking for to feel more confident.
Thank you. There is another question here. Why do we have to convert US dollars to Jamaican dollars to invest in Jamaican companies?
Well, I can take that one. So it depends. So it depends on the type of company, because we have companies listed on the Jamaica Stock Exchange. Some of them are denominated in Jamaican dollars in terms of the share, but we have others that are denominated in USD. So for most companies on the Jamaica Stock Exchange, they're denominated in Jamaican dollars. And so in order for you to make that investment, you'd have to do that conversion. But we do also have companies like Trans Jamaican Highway that has the shares denominated in both USD and Jamaican dollars. So there are different options on the Jamaica Stock Exchange. It's just that most of them are denominated in Jamaican dollars.
Thank you. And we have a question here that says, I like the equity fund. What is the minimum to invest in it?
Sure, I'll take that one, Oshane. So the minimum to invest in the Caribbean Equity Fund is 50,000 Jamaican dollars, and every investment that you make thereafter will be in 5,000 increments, $5,000 increments. And just to also add, we do have a feature where you can set up recurring orders. So if you want to have it, just like we'd have like an automatic savings plan, you can have an automatic investment plan where you set an amount that you like to have deducted and added to your fund each month for purchase, and that way you don't have to think about, oh, I should go ahead and put some money on my equity fund this month. It can be set up and you don't have to think about it. It just gets done on a monthly basis or whatever frequency you choose.
Thank you. Thank you, Andre. All right, I'm just looking to see if we have any more questions unanswered in the chat. Renard is asking, after starting to invest, how long before you start reaping rewards?
I wonder if Jimmy wants to take that one. I feel like I've been hugging the ball, but if you want to, you can take that one, Jim, but I can also take it as well.
All right, so the question is, how soon will they start to reap in rewards?
Correct.
So well, first and foremost, we do encourage we did a webinar the other day that speaks about we should not try to time the market, but rather spend time in the market, right? And that speaks to investing for the long haul, right? During the period, so it speaks to what we have identified here. So we mean identify assets or companies that are actually strong fundamentally and has long-term potential, right? And all these assets, right? I mean, in the short term, we might see fluctuations, right? But if you actually cash out at this time, it's possible that you might leave out, or you might leave profit on the table by staying in the market and trying to gain as much as you can in terms of what the asset has to offer. So definitely immediately you may see. So I mean, if you do buy a stock today, the price may appreciate tomorrow, and that's a benefit to you, as well as over time it will appreciate further and further, as long as it's a solid company, a company with strong fundamentals still. So we do recommend long-term investing. So yeah.
Thank you, Jamie. Trishelle is asking, is it better to invest in JMD or USD on the Jamaica Stock Exchange? But before you provide an answer, a poll has appeared on your screens. While we go through the final set of questions, you can go ahead and you can put your information in the poll and we will see the feedback. And if it requires a call, we'll give you a call. If it requires an email, we'll give you an email. A follow-up will be done. All right, so go ahead and do that. Go ahead with the answer. Is it better to invest in JMD or USD?
So again, it depends because on the face of it, regardless, especially if it's a case, for example, if you have Trans-Jamaican Highway, we have the JMD shares and you have the USD shares, it's the same exact stock. So in terms of the actual value of the company, you get the same value in whether or not you invest on the JMD or the USD side of things. However, sometimes it gets a little tricky because you might have liquidity differences. And when I mean liquidity differences, I mean in terms of trading activities and trading volumes. So what you might end up seeing is that even though they're the exact same stock, the USD stock might be trading higher than the JMD stock. And I believe that's the case right now with Trans-Jamaican Highway, where in terms of the equivalent, the conversion where you convert from USD to J dollars, I believe the USD price is technically priced at a lower price if you do the conversion right now than the JMD. And that would mean that there is a potential, what we call in the industry, arbitrage opportunity, where you can actually buy it at a much cheaper price and maybe even, and in terms of, so you'd be able to get it at a much lower price than if you bought it at on the JMD side of the market. And remember, guys, the principle is buy low and sell high. So for me, if you have the option between the two and you do the conversion and you realize that one is priced cheaper than the other, as long as they're both the same stock and as long as there's a buy recommendation out on it, it makes sense for you to buy it at the cheaper price, which is on the USD market. However, there might be some nuances in terms of liquidity and trade volume. So if the stock is a little bit too liquid, it might mean that it might be harder for you to exit your position. But in general, if you have the opportunity, all else equal, liquidity is pretty much around the same. It makes sense for you to, if you want to do the conversion and see which one is trading cheaper, then you'd be able to purchase that stock on that side of the market. So if the USD, if the USD is say, I'm gonna use the math might not work out, but just bear with me. Say, let's say the TJH share is trading at 2 cents and the USD share is trading at, I don't know, I want to say $3. My math might be off, or maybe the J dollar is trading at maybe like $4 or $5. Then that would mean that the USD share might be trading cheaper. It's the same exact stock, the same fundamentals, the same dividend payouts, everything is the same. Then it might make sense for you to buy it on the cheaper side of the market. Hopefully that answers the question.
Sounds clear. We have another question from Howard. He's asking if it is that he has to visit a branch to make purchases into the Caribbean Equity Fund, or is it something that he can do online?
Sure, Oisin. I'll take that one. So you can visit a branch or you can do it online after you're set up through the NCB CM app, which is very helpful and very convenient. So you can invest in the Caribbean Equity Fund from your couch, from the beach, wherever you are. You can get your orders placed through the app once you once you have signed up with us.
Thank you. And Mishka is asking a question here. How do global events or government policies affect different sectors, and how can investors adjust their stock choices to manage these risks?
And if Jamie wants to go first, but I can go as well. You want to go, or Jamie, or I can go, it's fine. Okay, I guess I'll go. So could you repeat the question again, please, Oisin? Sorry.
How do global events or government policies affect different sectors, and how can investors adjust their stock choices to manage these risks?
That's an excellent question. So let me answer the second half of the question first. And this is where the concept of diversification or even thematic investing comes into play. When we speak about diversification, because what the question was basically asking about was those major macroeconomic shocks or risks.
All right.
They say when America sneezes, and I use the United States as an example, they say when the America sneezes, Jamaica catches a cold. And that's just basically saying that, whatever happens especially because we're so economically tied, whatever positive or negative news happens in the United States, it has a ripple effect that comes to Jamaica, and it can affect our markets. And because there is so much uncertainty, that's why we're promoting, try to diversify. You want to get the best of both worlds, but even if we speak about renewable energy, for example, anything can happen that can derail, the target, or maybe the government won't be able to, the government might revise that target up or down. So there are many risks that you have to think about. And that's why we say, try to diversify your portfolio. Try to find the best in class companies that are in the best sectors, especially growth or mature sectors, and invest in those companies. Now, in terms of how can those risks affect outlooks in terms of our local industries, if I use, for example, the United States and its policy in terms of, its protectionist policy, meaning that it's more of an America First agenda that is being heralded in by the Trump administration. And one key concern is in terms of immigration, right? Immigration, and even those that might have green cards might have some apprehension in terms of, can I leave the United States, or even in terms of immigrants that might get deported. So a lot of those people that are immigrants, not just to Jamaica, to any country, especially emerging market countries, they rely heavily on what we call remittances, or people overseas that might have family at home. They might send back some money, right? So what might happen is, if there is a change that might affect those people that are living in diaspora, maybe there might be significant amounts of deportation. It might affect the amount of remittances that can come from the United States to Jamaica. So if we were looking on the industry or the sector outlook for the remittance industry specifically, and at first we're saying that, okay, things are looking well, the American economy is improving, we have a high density in terms of the diaspora, and they're continually sending money from overseas to Jamaica. But then all of a sudden now the Trump administration is saying, okay, we're going to clamp down on immigration. That might change the outlook or change the growth prospects of that specific industry. So what we're trying to say here is that large countries like the United States, they have significant economic ties to even small countries like Jamaica. And if there's any major change to policy in terms of their view on the world order, if there's any change to those policies, it can have an impact on us or the industries, the local industries, because of those strong economic ties. And if it's positive, it's good for us, our local industries. But if it's negative, it's bad for our industries. I can use another example in terms of renewable energy, where even the mandate of transitioning to renewable energies, a lot of it is influenced by global policy, where there's this global shift towards cleaner energy sources. So a lot of it is influenced by, global policy. But if that policy changes, it can have an impact in terms of the viability or the feasibility of our local mandates and our local policies, which can then trickle down into the industries. Because remember that a lot of the growth that we might project in terms of a specific industry can be influenced by our local government policies and things that we might be incentivizing. But if it's but our local policy is also influenced by international or on a higher level. So it can trickle down from, and again, it's I mentioned top down approach. It's top down approach. So like there are different layers to this. But I'd say that's at least one way in which global policies can affect our outlooks for our local industries, and subsequently the performance of the companies, even if it's a company that's a leader in that industry.
All right, and I just wanted to add to that. So global events generally does have an impact on our operations locally in terms of company. I mean, most company, I mean, one of the markets that they want to break into is the US market, or even European markets, are just China basically still. I mean, most of our sourcing would have come from China because of cheap labor, and I guess sourcing is actually cheaper there. So I remember when we had the shipping crisis, right? And that's a global event. That's like a shock that basically every manufacturer, every distributor would have mentioned that their margins would have been squeezed due to the fact that they would have been paying higher costs. Ships would have to take longer route to get their goods here, and that would have impacted their margins. So that would ultimately affect performance, and investors turn away from bad performance, and you would probably see that in the market in terms of the sentiments, in terms of stock price falling, given poor performance. So that's also another way. So we're very exposed to other countries, and given the fact that a lot of companies are mature, right? And we know that you might be mature in Jamaica, but there are opportunities elsewhere. So they actually look forward to export or actually import, right? Because as we say, a lot of stuff we don't manufacture. So even though we manufacture, I mean, we still source from elsewhere, and we do export other countries. And as such, these stuff may negatively affect us. When shipping prices eases, it actually benefits us. We actually see that in terms of where if there's a global challenge in terms of oil prices now, we see that way that impacts us also. So these are ways in which it affects the company. Our companies, our local companies rather. So, yes.
Thank you, Jamie. We have one final question. But before we get to the question, Jessica, if you can just send us a private message, you can put it in the poll as well, your contact details, and we will reach out to you. Also, Howard, you can use the app. It's the NCB Capital Markets Wealth Connect app. That is what you'd use to make purchases for the Caribbean Equity Fund. So question is from Claudette. What is your view of TJH? I'm assuming she's asking if you think it's a good buy.
Sure, I can answer that question. So the offer for sale would have closed recently, and it was at an attractive price of $3.60. And as not everyone, but those that would have paid attention or would have been in the space would have seen where there were different target prices that were given by independent investment houses. Our target price was approximately $4.43. I believe the stock price right now is maybe a little bit, I think it's above $4 at this point in time. So in terms of the additional value that's unlocked or that's in the stock price right now, there is still potential upside, but what I'd say is that it's not as attractive an entry point at this point in time, but that does not mean that this stock is not an attractive stock. You would have seen recently where they would have increased the dividend payouts. Initially, the interim dividend payouts would have been around, I believe it's around, is it 95 cents, I believe, or is it 9 cents per, and it would have increased to 12 cents. So that's a significant increase in terms of the dividend payouts. So what I'd say is that Trans-Jamaican Highway is still an attractive stock, and we expect to see dividend payouts increase over time as they pay down the debt. And remember that Phase 1C has not actually started to generate revenue for the business, and Phase 1C is the new toll road that the company would have won the right to own, operate, and then there are multiple other legs around the belt in terms of road works. There's roadways to be completed in Montego Bay, and there's been announcements for additional expansion of that toll road. Management would have even mentioned that they're looking to expand into Guyana if the opportunity is there. And we know that Guyana is this massive, booming, oil-driven economy, but they're diversifying. And with oil, there's going to be infrastructural development as the economy grows, which could mean additional toll roads. So what I'd say is that the stock is still a very strong opportunity for investors.
Gentlemen, thank you. This has been a very insightful discussion on how to evaluate industries. A huge thank you to you, panelists. Even greater thank you for the audience took their time to be here and to participate, ensure that this session stayed engaging. But before we wrap up, here are a few takeaways. Always analyze the fundamentals. Always compare companies within the industry and stay informed about trends. I remember at the beginning, I told you I would let you know which school I think will win champs. Now, if you can guess that school, you can put it in the chat. I stay diversified. Thank you all for being a part of today's discussion. If you have further questions, feel free to connect with us. Have a great day and happy investing.